Hello and welcome back to Stock Market Weekly. I'm your host, Evan Medeiros. I am off camera today and we are going to do a speed round through this week's trading. It was a very important week. I think there's lots of takeaways. There's lots of levels, moves, and sector movements we want to be paying attention to. But I'm very tight for time here recording on Friday. But I want to get this episode out. I'm going to try and keep it tight, actionable, with plenty of takeaways. So let's get into it. Before we do, our sponsor, though, IBD, Investors Business Daily. Let me see. I got a screen up here I can show you. Here it is. Market Surge. We've got a discount to their charting platform here. This is where I do all my fundamental analysis on stocks and a lot of sector analysis and industry analysis. So check it out. I got a link in the description of this episode once you get done watching today's video. Let's take a look at the numbers here. So 1 week returns, you can see just firmly red across the board. Dow Jones, Russell 2000, they were hit the hardest, 3 and 4% in the red. And then take a look at the fear indexes, the volatility in the Dow, the SPY, the Nasdaq. We are in mid to upper 20s. And for the Nasdaq, we are at a 31 VIX. Now, of course, the big, elephant in the room is the Iranian-Middle East conflict now. $91 a barrel of oil, 10-year treasury up to 4.14%. Basically, the only thing that hedged or really helped your portfolio this week was dollars. Gold didn't do it. If you had VIX calls, I guess, you benefited this week. But generally speaking, bonds didn't help. Gold didn't help. A lot of risk off traditional things that have been working didn't help. It was really dollars getting a big swift bounce, and of course oil. So let's talk about the sectors real quick. We had energy at the top of the list, the only thing green. Notice not that green though. For the spike that we saw in crude oil, energy stocks didn't really react, in lockstep. There's certainly some reluctance there. And I think that speaks to the fact that the market right now still sees this as a short-term spike in crude rather than a long, durable, persisting trend in that price. But there's plenty of down 3-4% sectors, lots of pain out there. And so let's get into the charts themselves, because I do want to spend some time looking at the levels. The headlines are going to be chaotic over the next week. And I think we need to really focus on the message of price action, because it's really going to be the ultimate truth arbiter here as we navigate a lot of these uncertainties. So here's the S&P 500. There's a clear thing that happened this week is we did break down. So 6,800, this has been roughly the low for the last 2 months or so, really 3 months. In the S&P 500, lots of chop, lots of tight sideways trading, and we did break down. This is the weekly bar here, down 2%. Most of that fallout happening on Friday, really, Thursday, Friday combo. And so, objectively here as traders, risk managers, this is a spot where you need to pay attention. You're below the low end of the range. You're starting to roll over. This is where you have the potential to get ugly, is when you start to roll below all of this overhead supply in here. So everyone that's been buying and selling, mostly buying that we care about in here, is now starting to be underwater. And if we stay down here, that becomes a problem of folks wanting to get out. Nasdaq 100 notably didn't break lower this week. It's still in its at least its immediate range here. So the last 30 days, 40 days of trading, we've been in this 592 to 615 or so area, and we're still hanging out here. It was a down 1% week for the Nasdaq, so there was some relative performance in technology for the first time in a while, but it doesn't look all that healthy. And when we zoom out here, it still looks like a just big mess of a pattern. This is really the broader range we could kind of point ourselves to. And the market has just been super sticky in here since October, going nowhere. And if we take a look here at the Dow this week, so this was one of the worst performing weeks for the Dow Jones. You can see volume picking up, and we, broke kind of, whoops, what is that? Let's get rid of that. We broke pretty much all, recent trend lines in the Dow, right? Kind of a follow through down week here, and some pretty ugly price action. If we look at the Russell 2000, this sort of rolled over here. So from a technical perspective, right, there's definitely technical damage that has been accounted for this week. That's all the negative, right? So that's things that we want to be paying attention to. We want to be risk managing. We want to be taking exposure down. That's the negative side. Let me give you the positive side here. Let's take the other glass half full view of this market right now, because we tend to always try and give both scenarios here, try and objectively lay out the kind of bull and bear case, and then present the evidence and see where it all stacks up. If we take a look at the VIX, going into a weekend, pushing 30 going into the weekend here. So it is safe to say that there is plenty of fear priced into the market and discounting uncertainty here into the future. And what we know is that with so much protection purchased, with many investors kind of throwing in the towel saying, I don't want to deal with this market because A, it's either too choppy and range bound, or now B, we have this, potentially never ending war in the Middle East. There are just countless reasons why the leveraged bull, or even just the aggressive bull, the moderate bull in this market is taking a back seat. And so if we get any sense of a ceasefire, or we get better than expected news where this gets to a resolution faster, let's say certainly over the weekend, but even by next week, then you have lots of fuel, you have lots of buying energy that is likely to spark and come, racing back into this market very quickly here. And so again, it's just trying to get a sense of positioning here, and positioning relative to kind of the market expectation and the current news flow. And so while it is, something where we want to be prudent, we want to take action and be, astute risk managers. I think that is first and foremost. I don't think anybody should be 100% long blindly here, or worse on leverage. I think those are terrible ideas. But I do think you need to keep an open mind that if the news kind of comes in better than expected, and we do find that these lower levels hold, 590 holds or 580 holds in the Qs, then you have to be open-minded that you could run this back really quickly here. And I think it's just not getting off sides too strongly on either side of, frankly, the market right now. And again, this is really speaking to the active traders. If you're a longer-term investor, or if you're someone that just loves, more calm trading, trend following, longer, you're taking a back seat here no matter what. You're probably not engaging too much or trying to make too many decisions right now because it is too chaotic, or frankly, the trends on the longer time frames haven't turned. Our Galahad trading system is still long the Qs here. It's been long, I'll just say forever, but it's been long since coming out of the depths of the tariff tantrum in May timeframe. And so it's just been kind of riding out through a bunch of chop. Our stop continues to rise, right? We have insurance in place if anything goes super south here on a weekend where we can't get out at our stop. So we've got protections in place, but we're still long here because Galahad's taking a long-term view, and it's saying, I don't really care about this chop right now. It hasn't, even at this length, gotten long enough for me to want to exit. So, perspective, time frame is everything. This is always when market vol picks up and we start to get pullbacks. I start to talk a lot more about time frames because I think it's just so important. And I think you just need to know where you live right now on that time frame spectrum. I think if you're shorter term, if you're trying to be opportunistic, you've got lots to do right now. I think thinking about positioning and where the distribution's not getting fully priced in, right? I think there's just a lot of pricing in on negative things happening over the next several weeks. And so if you start to get something incrementally positive, right? If you start to shift that distribution a little bit, then that's where you can get those sparks. And that's also what makes this regime so tough to trade is because you have lots of folks that are hedged right now. And so trying to get that breakdown when, you'd expect it to, it just becomes difficult. So all is to say, let's keep an open mind here. Let's follow price, right? If we start losing 590 or so and things start spiraling, then, kind of batten down the hatches. But until then, let's try and keep an open mind, and let's take a look at some other names now. Here, let's look at gold. So again, gold down 2% this week. Not quite the safety haven, but, still kind of hanging on its upper trajectory here. Getting a little bit messy, but it rebounded on Friday, so that gave a little bit of saving grace there going into the weekend. Here's crude oil, or at least the USO ETF proxy is just going vertical right now. If we look at XLE, hasn't done that, right? So again, that's sort of that disconnect. We already looked at the VIX. I want to spend a little bit of time looking at some other areas of the market, emerging markets, right? EEM. So for those of you who may have ignored or didn't get on board emerging market trends, ACWX, right? You're getting your chance to get in at a pullback here. Again, not saying the pullbacks are done, but you saw some severe, fast corrections here in some of these other world stocks. So something to pay attention to do some homework on. I did pick up a little bit of EEM, but it's still a small position for me towards the end of this week. So I think those spots are interesting. They're notable. I think semis are starting to put in a more meaningful pullback. They're just crossed 10% of a pullback on Friday. I still think we could see lower. I'd get more interested probably in the 360s or so if we get more to like the more like the 15% correction, maybe undercut these February or these January lows here. That would be starting to get a little more attractive from a price perspective. But, we're starting to see a little bit of selling pressure in a very resilient spot. And I think software, which is on everyone's mind here this week, I posted last week about the opening at the lows, closing at the highs, right? And we've just seen now, 9 sessions of straight open low, close high, open low, close high. There's been a tremendous amount of volume. I will say, though, I would not want to be overstaying the welcome here in software. I do think this bounce is probably a bounce to sell. Again, I don't have a horse in this race. I'm not long. I'm not short IGV. And I think this could continue up. I think we could go into the 90s, low to mid 90s, maybe another 2 to 5% bounce, maybe even fill this gap. But I think that there is plenty of kind of trapped overhead supply up here that maybe got caught off guard on the magnitude of the selling. And I think, some of the explanation this week could, be explained by the large sort of degrossing and selling that software saw first and foremost. In other words, there wasn't a lot of money still hiding out here after the war broke out this week. You had a lot of, again, money parked in semis, in international stocks, in gold. These were kind of the liquidity piles where the trends were kind of coasting up. And I think when you started to get the fear, the headlines kind of coming out this week, those were some of the hardest hit. I think that in my head explains a lot of that move. Yes, I think there's some relative value underneath the hood in some individual stocks, but I still don't really love IGV as a broad bet, just generally speaking. So I think those are kind of the big themes I wanted to talk about today. Let's keep an open mind. Let's continue to manage risk. Let's follow our levels. I think having a shopping list, right, especially at times like this where you may get a quick move, a sharp move overnight or into the next session. And so having a shopping list or levels that you would buy at a price discount or a price breakout, those are things you want to start to do now. Do it ahead of time. Do it while markets are closed. And that way you're just more objective about kind of the actions that you want to take. And I think, this is just a market where you want to reassess your time frame, your activity level. If you're tired, if you're getting worn out, makes total sense, right? That's what the market's great at doing right now. And it's wearing a lot of traders out. So, take a few days off, again, know your levels and just re-engage when the regime starts to align more so with your trading style. So that is it. That is what I have for today. We'll be back full length next week with more individual trade ideas from our systems. But For now, we got some links in the description of the show if you want to check those out, and our sponsor, IBD. Have yourself a great weekend. We'll see you back here next Friday. Take care.